Welcome back to the channel. Today we're diving deep into one of the most widely discussed ETFs for income-seeking and retirement investors, the Schwab U.S. Dividend Equity ETF, also known by its ticker SCHD. Whether you're a seasoned investor looking for steady dividends or someone planning for long-term retirement income, this ETF has been attracting attention for several reasons. Over the next several minutes, we'll explore what SCHD is, how it works, what makes it unique, its performance history, and how it compares with other similar dividend-focused ETFs in the market. So sit back, relax, and let's get into it. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. SCHD, or the Schwab U.S. Dividend Equity ETF, is essentially an exchange-traded fund that aims to replicate the performance of the Dow Jones U.S. Dividend 100 Index. This index consists of 100 U.S. companies with a track record of consistently paying dividends. What's unique about SCHD is its screening process. It doesn't just include any company that pays dividends, it looks for companies that have strong balance sheets, robust profitability, and consistent dividend histories. This approach helps ensure that investors are exposed to high-quality, financially stable companies rather than risky or inconsistent payers. As of now, SCHD trades at around $28 per share, offering an attractive dividend yield of approximately 3.8%. This is more than 3 times the average yield of typical S&P 500 stocks, making it particularly appealing for investors who prioritize income generation. SCHD's portfolio consists of roughly 100 stocks, spanning a variety of sectors to provide diversification and stability. The fund naturally favors sectors that are known for stability and dividend payouts, including energy, consumer staples, and healthcare. Specifically, energy stocks account for about 19.34%, consumer staples around 18.5%, and healthcare nearly 16% of the fund. This deliberate tilting toward defensive sectors is designed to provide investors with resilience through varying economic cycles. Energy and consumer staples in particular tend to maintain cash flows even during economic slowdowns, which can be a stabilizing factor for the ETF's overall performance. Healthcare, meanwhile, remains consistently in demand and also contributes to the stability of dividends over time. In terms of the companies themselves, SCHD includes major well-known names like Bristol-Myers Squibb, Cisco, ConocoPhillips, PepsiCo, Lockheed Martin, Coca-Cola, and Verizon. These are large, financially strong companies with proven track records, which helps reduce the overall investment risk. An important aspect of SCHD's portfolio is that more than 58% of its holdings are companies with market capitalizations of $70 billion or higher. This is significant because it means that the dividend income generated by the fund comes primarily from established, blue-chip companies. For investors, this is a key consideration. Large-cap companies are generally less volatile and more reliable in their dividend payments, compared to smaller, less established firms. Additionally, SCHD has a remarkably low expense ratio of just 0.06%. This is exceptionally low, especially when compared to many other actively managed funds. Low costs mean that a higher portion of your investment goes toward generating returns rather than being eaten up by fees. Looking at its performance over the past decade, SCHD has delivered a total return of over 200%. While this is slightly below the performance of the broader S&P 500 index during the same period, it still translates into an annualized return of roughly 11 to 12%, depending on the year in question. For investors seeking a basket of high-quality, dividend-paying companies, this makes SCHD an attractive option. The combination of consistent dividends, large cap exposure, and relatively low volatility positions it as a dependable component for retirement portfolios or income-focused investment strategies. Before we jump into alternatives, it's worth mentioning that the Motley Fool Stock Advisor and similar stock-picking services have identified top-performing individual stocks over the years. For example, stocks like Netflix in 2004 and Nvidia in 2005 would have delivered staggering returns for early investors. While these individual stock picks are impressive, investing in a single high-growth stock carries substantial risk. One underperforming company can significantly impact your portfolio. That's where ETFs like SCHD come in. They provide a diversified basket of high-quality stocks, reducing single-stock risk while still offering attractive dividend yields. For retirees or investors looking for relatively safe income, SCHD offers several advantages. First, because it holds 100 well-established companies, the fund isn't dependent on any single stock. This reduces the likelihood of a sudden dividend cut impacting your income. Second, the low beta of under 0.7 over the past 5 years indicates that SCHD tends to experience less price volatility than the broader market. For risk-averse investors, this stability is a critical feature. Third, the ETF's focus on defensive sectors like energy, consumer staples, and healthcare adds another layer of protection, ensuring that dividend income is more reliable even during economic downturns. Let's take a closer look at some other ETFs in the dividend income space. First, there's the iShares Core Dividend Growth ETF, DGRO. DGRO has a slightly lower yield, around 2%, but focuses on dividend growth companies, those with a track record of steadily increasing their dividends. The fund is fairly diversified with around 400 stocks and includes major companies like Johnson & Johnson, ExxonMobil, Apple, and Microsoft. While the yield is modest, the potential for rising dividends over time makes it appealing for long-term income investors. Second, we have the ProShares S&P 500 Dividend Aristocrats ETF, NOBL. This fund targets companies that have increased their dividends for at least 25 consecutive years. NOBL offers slightly over a 2% dividend yield and maintains a beta of 0.77, indicating moderate stability. Its expense ratio is slightly higher at 0.35%, but it still provides excellent diversification, with no single stock comprising more than 2% of the portfolio. SCHD is unique because it balances income, stability, and growth potential. The fund's portfolio has a modest price-to-earnings ratio of less than 17, which is reasonable for blue-chip dividend-paying stocks. Additionally, its low exposure to tech stocks, just 8%, minimizes volatility typically associated with high-growth sectors. Energy and consumer staples, which together make up almost 38% of the fund, act as stabilizers, especially in uncertain market conditions. Over the past year, SCHD has increased by just over 1%, demonstrating its relatively steady performance compared to more volatile ETFs or individual stocks. So what makes SCHD attractive for investors today? First, reliable dividend income that is more than 3 times higher than the S&P 500 average. Second, diversification across large, stable companies that reduces risk. Third, low fees and manageable volatility, making it a smart choice for both new and experienced investors seeking steady income. While SCHD may not always outperform high-growth stocks, its consistency and income-focused approach make it ideal for retirees or anyone looking to supplement income without taking excessive market risk. For those who want additional options, DGRO and NOBL provide different approaches to dividend investing. DGRO focuses on growing dividends over time, while NOBL emphasizes long-term dividend stability through aristocrat companies. To sum it all up, the Schwab U.S. Dividend Equity ETF, SCHD, is a strong income-focused ETF that has proven its value over the years. It's not about chasing the fastest-growing stock or the highest short-term returns. Instead, it's about steady, dependable dividends from financially strong companies. With low fees, strong sector allocation, and a history of solid returns, SCHD remains one of the top choices for income-seeking investors, especially retirees. Remember, though, every investment carries risk. Always consider your personal financial situation, investment goals, and conduct your own research before putting money into any ETF. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.